This is Brian Beaulieu, CEO, Chief Economist for ITR Economics, and thank you for joining us for this edition of Fed Watch. You're watching this on March 24th. The most noteworthy thing that's new over the last week was the Fed only raised the Fed funds rate 25 basis points. So we're now running between 475 and 50, or 5.0% on the range, which is good. I don't think they had to put interest rates up at all. The street seemed to be interested in whether they were going to bother or not, given SVB and Signature, and then First Republic and Credit Suisse, which had nothing to do with what the Fed is doing directly anyways. But I guess I felt they had to do something. 25 bips, though, is at least a nod toward sanity, which is great. Question we're getting frequently is how much more rate increase do you think we are going to get, Brian, or ITR and economics in general? And the way I posted is we have built into our thinking regarding the slope of 2023 and 24, we have between 75 and 150 basis point rise. That was our margin that we assumed that the Fed was going to do, that there would be somewhere in between there. So now we've had 50 basis points since we laid that out. So if they do another 25, nothing changes. If they go up another 100 bips between now and the end of the second quarter, nothing really changes in our outlook. The wheels have already been set in motion. As I mentioned last time, we don't think that what's going on with the failures is systemic. It's two banks, two unique banks. Another stat that I came across, though, over the last week is 94% of the deposits at SVB were above the insurance level and 90% at Signature. They were very, very strange banks in that regard, very focused, and in the case of SVB anyways, way too heavy into bonds, where they saw, because they had to mark the market, their valuations go down. That's not a systemic problem. As I mentioned, a balanced portfolio, loan portfolio is the key to good health and maintaining a reasonable ratio of uninsured to insured deposits. Don't see it spreading. 25 basis points was good news. What the Fed did in terms of insuring all depositors at those two banks, well, as an economist, I don't like it because it creates a moral hazard. It worked for them in 2009 in terms of stopping a spreading panic. So I understand why they did it, and I think it's going to work again this time. It's just not a great long-term plan. So that's the update for this week. More good than bad, really. It was only 25 bips, and nod to sanity, and we haven't had more and more bank failures or any of that crisis nonsense. Thanks for joining us. I look forward to seeing you next Friday. Thank you.